Today's topic is a relatively much used investment instrument, which is none other than government bonds. When a company needs money, it has three options to choose from. The first is to take out a loan from a bank. The second is to issue a bond, which is also a debt instrument, except that it is not from only a single or a few banks but from a number of investors. The third option is to issue shares, so to bring new owners into the business, and with them new capital. A state has three options too if it needs additional capital. It cannot issue shares, because then you would be the owner of the state and could exercise ownership rights, but this would not be viable in a democracy. So this route is out. Any state can borrow either from another state or from a bank, and can also attract new investors by issuing bonds. In addition, the state has the option of printing money as a concrete way of raising money. A government bond is a bond in the same way as, say, a corporate bond, the only difference being that it is issued by a government. As the general characteristics of bonds also apply to government bonds, I suggest you also have a look at the section on bonds, the link to which can be found here. This video will focus on the unique features of government bonds, so that if you decide to invest in this instrument, you will know what your money will be invested in. Let's start at the beginning with a definition and look at what a government bond is. A government bond is a negotiable debt security issued by the government. It is similar to a bank deposit, with two small differences. One is that with a bank deposit you lend your money to the bank, with a government bond you lend your money to the government. The other difference is that a government bond is not a deposit, but a security. It is this latter feature that allows you to redeem it before maturity without losing the interest. Let us also say a few words about the characteristics of a government bond. The first question is whether it is safe. Money lent to any state, such as the Hungarian state, can be returned to you unless the state goes bankrupt. While this risk is not zero for any state, it is far less likely than if we were to look at the question for a business. Unlike you, the state has the right to print money, so apart from bankruptcy, the repayment of principal and interest is always guaranteed. That is why it also acts as a benchmark, against which all other investments are compared. The safety of investments can also be described as the investment that is safer if its price fluctuates less. In fact, in this respect too, it is by far safer than, say, a share. If you consider it safer to live on the money you get back from your investment in a few years' time than if you had not invested it, then a well-managed basket of other investment instruments is far safer. They protect against inflation better than government bonds. The other issue is flexibility and customization. Government bonds offer you a choice in terms of both interest rates and maturity. Moreover, as there is a one-fourth nominal value, you will also have complete freedom to decide the amount you want to invest. What's more, you can also choose the sales channel that suits you best. Each one is a little different, so let's briefly run through where you can buy government bonds. First of all, of course, from the Hungarian state treasury. Here you can buy at a low cost, but it will take you back at a discount if you cancel early. You can also buy in a bank. They will not offer it to you automatically, as they will offer you their own range of products. But they can serve you. You can get government bonds through investment providers and brokerage firms. You can also buy other securities through them, so you can build a complete portfolio. Let's also talk a little about the types of government securities. We won't go through the whole range now, because then you could watch the video for a very long time. Basically, we can divide them into two main groups. The first is the government bond. These are bonds, as their name suggests, but with a maturity of at least 1 year. They pay you interest every quarter, every 6 months, or every year in a predetermined way. Or there are discount treasury bills. These mature within a year and pay no interest. You earn a profit because they are issued at a price below their face value. That is, for example, you can buy a discount treasury bill with a face value of 10,000 forint for 9,500 forint at the time of subscription, and receive 10,000 forint at maturity, so your profit is the difference between the two. Next, Let's look at what you can use the government bond for. If I had to summarize briefly and succinctly, I could say that you can typically do two things with it. The first is that you can use it to store value. Similar to a bank deposit, you can hold the money you want to use in a relatively short period of time, a few years at most. If you really don't want to deal with your own money, but you want a better result than the bank options, you can choose this. It is not advisable to buy government bonds for a very long time, as you can put your money elsewhere to work more efficiently. The other use is that you can also use it to diversify your investment portfolio if you choose it well. This also reduces your overall risk. You can rebalance your investments in the short term, say as you get closer to your goals, or even when you don't need to cash in when you want to wait a while before making an investment decision. Having said that, properly selected, you may wonder what it is that affects the return on your government bond. Many factors affect government bond yields, many of which leading economists have addressed in greater depth, so for now just in a nutshell. First, the returns available from other investments, such as government bond yields in other countries. What matters to an investor is usually the yields available at a given level of risk, so if they can get that elsewhere, it makes almost no difference to them which one they choose. If demand falls as a result, the exchange rate may fall. The second factor is the level of the base rate of the central bank. A video on the base rate of the central bank was published earlier, you can access it here. Although this cannot be summarized 100% in 2 sentences, the point is that if the base rate rises, exchange rates may fall. The third factor is the risk rating of the issuing country. Governments, like larger companies, are rated based on their management. There are several rating companies, the 3 most well-known of which you have probably heard of are Fitch, Moody's and Standard & Poor's. The more stable a state's management is, the better its rating, as it carries less risk. Here again, the higher the risk, the higher the interest rate the state offers on its own paper. The impact of this point can be felt at the time of the annual revaluation. An important factor in the rating is how the current government balances the budget, so whether it is self-financing or borrowing more. Currently, Hungary's rating falls into the lower middle category. This is still just right for institutional investors to seek Hungarian government bonds, but we would not be in this position a little lower. The next factor is the average remaining maturity of the security. The time remaining does not make a government bond cheaper or more expensive, but it is a factor that amplifies or weakens everything else. Interest rate sensitivity is measured by the duration, which represents the average remaining maturity. The longer the duration, the more sensitive the exchange rate will be to interest rate changes. The shorter the duration, the more stable the exchange rate will be. And as the maturity date approaches, the nominal value and the current value will move closer and closer together, and at the very end the two will be equal. Let's talk a little about the disadvantages of government bonds. There is no investment that is always perfect for everyone. At most there are options that are better suited to one purpose or another. Accordingly, government bonds also have some features that are not usually advertised. The first is the yield. You've probably heard of the investment triangle. That is the 3 of safety, availability and yield are not achieved simultaneously. Since government bonds are safe in the sense that you are almost guaranteed to get your money back in the interest, as well as being accessible with relatively minimal loss, it is the yield that is compromised. The other is the inflationary effect. You can access a video about what inflation is here. It has to do with government bonds in that the government is not a productive enterprise, so it can choose. First option is to do nothing and go bankrupt. This is not usually preferred. The second is that in order to pay the interest, it raises taxes. This is not necessarily a viable option either, because in that case it would be able to finance the interest on the growing stock of government bonds by raising taxes again and again, which would then make many productive activities impossible. Thirdly, it prints money, thus constantly weakening the forint. In this way, it can pay the interest on an ever weaker forint. As far as interest rates are concerned, it makes almost no difference which option you look at, fixed, floating or inflation-linked. In the long run, keeping your investment in government bonds will pay you with money that will be worth less and less. That is, it will grow numerically, but its purchasing value will decrease. If you look at the graph, you will see that there is a striking similarity between the yield on a government bond and the level of inflation recorded by the Central Statistics Office. Remember that the current inflation rate is an average. Your purchases could easily see price increases above this. And this is not only the case for Hungarian government bonds, but for all governments. The third thing I should definitely mention is supervision. If any financial institution does not act with the product it issues in the way it is contractually or generally expected to act, you can go to many places with complaints. For example, to the consumer protection authorities, or even to the main supervisor, to the MNB. Government securities are, as you can see from their name, a public sector product, which by law is above everything else. That is, it has no supervisory body, although there are complaint handling regulations, and there are laws that regulate, say, data management and so on, but if I simplify it very much, the supervision is exercised by the state over itself. This even includes, if the state so decides, the possibility of adjusting the redemption value of government bonds that are already running. It is unlikely to do so, but it has the right to do so. In conclusion, let's look at what government securities to buy if you decide to do so. Obviously, nobody has a magic bullet, which is why this is by no means investment advice, just a summary. In the secondary market, where among other things, government bonds already issued change hands, you can buy a variety of maturities. These vary in their interest rates, so you could say that it's as simple as that. You buy the high interest, long maturity paper and you're done. You can do it obviously, but it has the same implications as any other security. That is, it's already priced in by the market. It's not just that you want to buy a government security, but what kind of government security? A paper with a higher yield due to higher interest rates will obviously be more expensive than a paper with a more modest yield. That is why the following summary will apply to newly issued bonds as well as those already in circulation. If you're interested in this in more depth, feel free to ask in the comments or contact us using the link in the description. You can choose a government bond paying inflation plus all %. Since inflation is the actual price increase for the average person, as determined by the statistical office, don't forget that the actual inflation for you will probably be as much as the total interest you are offered. Also, in general, the right choice for you will depend on whether the actual interest rate level at the time of purchase is expected to rise or fall. If you believe that interest rates will fall, you should buy long-term government bonds. In this case, you have bought a paper issued at a higher interest rate, which will give you that interest rate for a long time. And if interest rates fall, duration will magnify the effect, meaning that the price of your paper will rise. I note in parentheses that German government bonds, currently trading at negative interest rates, are being bought partly because they are expected to fall further. In other words, they want to lock in a relatively higher interest rate. Let's take the example that you bought the paper, say somewhere here, at a fairly high interest rate. If it's a long-term paper, you will be paid this high interest rate for a long time, and a fall in the base rate will make it even more valuable. If you think interest rates are down and the base rate level is going to rise, then forget about long-dated government bonds. After all, duration will still work then, just against you. Then they will lock in a leaner interest payment for a long time. In this case, prefer short-dated paper. You'll also lock in a lower interest rate, but the shorter duration means you'll be much less affected by duration. Going back to the previous example, a paper bought at a lower interest rate will be even less valuable if the interest rate rises, but choosing a short maturity makes it easier to replace it with a paper that is more favorable to you.